Cost of equity share capital. Just like any other source of finance, cost of equity is expectation of equity shareholders. We know that value is performance divided by expectations. If we know value and performance, then we can calculate expectation as a balancing figure. Here performance means the amount paid by the company to investors, like interest, dividend, redemption price, etc. Different methods are employed to compute the cost of equity share capital. If dividend is expected to be constant, then dividend price approach should be used. If earning per share is expected to be constant, then earning price approach should be used. If dividend and earning are expected to grow at a constant rate, then growth approach, which is also named as Gordon's model, should be used. If it is difficult to forecast future, then realized yield approach should be used, which looks into past. Capital asset pricing model calculates cost of equity based on risk. Dividend price approach. This is also known as dividend valuation model. This model makes an assumption that the dividend per share is expected to remain constant forever. Here, cost of equity capital is computed by dividing the expected dividend by market price per share as follows. Where K is equal to cost of equity, D is equal to expected dividend, P0 is equal to market price of equity. Earning price approach. The advocates of this approach correlate the earnings of the company with the market price of its share. Accordingly, the cost of equity share capital would be based upon the expected rate of earnings of a company. The argument is that each investor expects a certain amount of earnings, whether distributed or not, from the company in whose shares he invests. Where E is equal to current earnings per share, P is equal to market share price. This approach assumes that earning per share will remain constant forever. The earning price approach is similar to the dividend price approach, only it seeks to nullify the effect of changes in the dividend policy. Growth approach or Gordon's model. As per this approach, the rate of dividend growth remains constant. Where earnings, dividends and equity share price all grow at the same rate, the cost of equity capital may be computed as follows. where D1 is equal to D0, 1 plus G, i.e. next expected dividend P0 is equal to current market price per share. G is equal to constant growth rate of dividend. Cost of convertible debenture. Holders of the convertible debentures has the option to either get the debentures redeemed into the cash or get specified numbers of companies' shares in lieu of cash. The calculation of cost of convertible debentures are very much similar to the redeemable debentures. While determining the redemption value of the debentures, it is assumed that all the debenture holders will choose the option which has the higher value, and accordingly it is considered to calculate cost of debt.